for tuning in. My name is Dana Moody, and I'm a member of the Index Sales Group here at FTSE Russell. Just to set the stage for today's discussion, we'll be touching on broader macro trends that are impacting markets and may impact how investors should think about portfolio construction moving forward. I'm joined by a great panel today. Starting on my left, we have Catherine Yoshimoto. She's a director of equity product here at FTSE Russell. We also have Andrey Kotlyarenko. He's a senior equity product specialist at Vanguard. And lastly, we have Mark Barnes. He's the head of investment research Americas at FTSE Russell. And as I alluded to, we'll be touching on macro trends, so really that future outlook that will be impacting markets and what should be on investors' radar. So just to jump into it, as we approach the end of 2025, and again, there's a lot of macro themes that are bubbling up to the surface. I would love for the panel to kind of touch on some of these key themes and how the impact on markets may inform investors' approach to asset allocation in the future. So we'll start with you, Mark.
Yep. So I think when I think about the important themes in the macro economy today, it basically is the policy uncertainty that we see affecting the macro economy, and then obviously that filters through and affects markets, and particularly the equity markets. If you think about some of the themes, and these are not necessarily new, but they persist. So one is tariffs. Now, it seems like we don't hear quite as much about tariffs. It's kind of faded a little bit to the background. But as we've seen recently, it can pop up in places you weren't expecting. So we've seen that there have been some trade agreements with some of the major trading partners. But then we'll see new tariffs proposed based on the industry or sector that we hadn't even thought of, that they would happen. So that's one source of uncertainty. Monetary policy is a big one. Now the Fed finally cut policy rates again in September. And this is despite the fact that both inflation, realized inflation and expected inflation continues to be quite high and quite high above the 2% target that the Fed would like to see. GDP growth, realized GDP growth also has been fairly robust. So the question is, well, why did the Fed cut? But some of this is because they are looking at labor market and the possibility of disintegration in the labor market. And as that deteriorates, then they would need to cut. So they're trying to get out in front of that. But the tension between the inflation that we see in the economy and the potential for deterioration of the labor market there's tension within the monetary policy, and you're just not really sure which way it's going to go. Another thing is just globally, a lot of the central banks have been cutting policy rates. We've seen short rates coming down, but in many countries, long rates tend to be sticky. They tend to be fairly high. And long rates obviously are the ones that are most important for investors and households and businesses and so on. So as this yield curve steepens, it can have an impact on the economy. So why is that happening? I think that from a fiscal policy standpoint, there is a lot of concern, again, globally, of the sustainability of some of the fiscal deficits that some of these countries are running, including the United States. So all of these areas of policy, there's a lot of uncertainty, and they have direct impacts on the macroeconomy that then filters into the equity markets. So I think it's important for investors to be aware of these risks, and then again to think about what risks are in their portfolios and how they can mitigate them, perhaps through diversification.
Thanks, Mark. Thanks for providing that overview of the macro factors impacting markets and how investors should be thinking about that. Further on the point on investors and that approach, Andrey, I would love to get your view on what you're seeing from Vanguard's clients and how they're approaching these different market themes.
I think Mark brings up a lot of very interesting points that further support for need for global diversification, right? And one of those things is market uncertainty. And as people try to reduce the concentration that they have in their portfolio and kind of reduce the risk of that uncertainty, that most likely will further fuel some of the flows to the international market. That's also indicated by some of the forecasting models that Vanguard has, as it is in our view that over the next 10 years, international market will outperform US, further supporting the need of diversification into the international segment of the equities. Now, we also think that there's two dynamics at play that could potentially be in tension with each other, but one of those things is that AI could be transformative going forward. and really continue to drive additional productivity as well as growth in a lot of these companies. And year to date, AI innovation been primarily concentrated in the US market, while we think the adoption will be more of a global phenomenon. And as countries are able to capitalize on integrating AI into their business models, whether it comes to manufacturing or services, it could potentially create additional growth on the international market and global market overall. On the flip side, if AI is disappointing and maybe doesn't meet this high of expectations, that could create a prolonged environment of increased budgetary deficit, increased inflation, as well as increased interest rate that could disproportionately impact the US market, further supporting the need for global diversification across the equity spectrum. And last thing that I would end on is as the market uncertainty grows when it comes to geopolitical risk, the certain segments of the market could respond to it very differently, right? So concentration to a single sector could really create a stressful environment for a portfolio. So broad diversification across the globe could reduce those risks across the strategies.
Thanks, Andrey. I think you hit on some key points, especially with the adoption of AI and the broader implications and how investors are thinking about gaining access to these different technologies and macro themes. So digging a little deeper on that, and Andrey's point, Catherine, what are we seeing from clients? How are they thinking about indexes or different investment vehicles to construct, to access this and kind of take advantage of some of these things?
I think what we've seen with the growth of indexing and just the popularity of ETFs in general is a desire from investors, market participants to learn more. I think retail investors in particular have probably gotten more sophisticated than, say, 10 years ago. And I think they're becoming more active. There's talk of, how investors have to own their retirement more directly, right? It's moving from DB to DC. That's the trend in the market. And so ETFs will play an even bigger role in that future. And investors are trying to understand better, right, how indexes are constructed. And that's why it's really important for fund sponsors like Vanguard or FTSE Russell as an index provider to understand the market needs and how best to provide more flexibility and choice in terms of what they're looking for. Taking the example of India, for example, India has seen a lot of growth. And with that, the consumer, the middle class has grown. And then, you're seeing a lot more banks, for example, and investors in India may be looking for more ways to grow their wealth over time. So I think it's a pretty complex picture in terms of, the uncertainty of the future, wanting to diversify, so to reduce the risk in portfolios. But there's also this, I think, a growing user base of indexes and ETFs that's trying to better understand what opportunities there are available and, how index providers and fund sponsors can respond by providing more opportunities to meet their needs.
All right, with that, I want to thank our panel for joining and providing great insights into recent market trends in terms of increased adoption of international equity ETFs by investors, but also best practices for portfolio construction to gain exposure to some of these market themes. Thank you.